I'm Denise Genovese, Associate Editor at Unquote, and I'm here at IPEM, the private equity conference in Cannes, with Marc Frappier from Eurazeo. Marc, we hear so much about how high the valuations are at the moment. What, in your opinion, where are the valuations at the moment?
Well, I won't surprise you, but the valuations have gone up consistently over the last 5 years, and I think it's a function of more money coming into the system. There's an accumulation of wealth in the LP communities, in the pension funds, and that is looking for a place to be invested. And unfortunately, the assets in which we can invest in private equity, especially in Europe, are not growing as fast as the amount of money that is being raised. So there's a mechanical effect on asset prices, and you see that in private equity, you see that in the listed stock market as well. So that is a phenomenon that has been going on for 5 years. It's here to stay, most likely. So that means we have to take into account those prices, but also the risk of a downturn. Everybody is anticipating that the current growth environment will slow down. We've seen the stock market slowing down over the last 2 months, and that's probably an early sign of valuations probably plateauing or maybe decreasing over time.
And how do you make sure that you don't overpay for an asset, or perhaps it doesn't matter?
Well, it's usually it generates a lot of debates within the teams, because the way we look at asset value is on a relative basis. There's no absolute value for an asset. It's always relative to peers, which are either listed peers or comparable transactions. And that's the way we benchmark all the time the opportunities that were being offered. So first of all, we make sure that in the current environment we don't overpay for an asset. But what we look at is also versus 5 years ago, what was this industry trading at? And what we're seeing over the last 5 years, probably that the industry is trading 2 to 3 turns above their 5 years or 10 years average. So that's something we're very aware of. And what we're doing is that we're anticipating that upon exit, when we'll sell those assets, we will sell them at a lower price and probably a price closer to the historical average. So we're implicitly creating a buffer in our investment thesis, so we can cope for a reduction in valuation. But by doing that, we're shooting ourselves in the foot. Because we're destroying value day one, and that means we have to work harder on creating value or buying assets that have optionality to be able to create additional value faster, better, because of that potential value destruction from the multiple. And that requires a lot of levers, and we can talk about it in more detail, that help us be confident in the value creation prospect of the company.
How are GPs responding to the increasing amounts of competition amongst themselves as well as for assets? Are they choosing to diversify or are they choosing to become more specialized?
So there's different strategies. I think that the one that we've been pursuing is probably around 3 different elements. Number one, we're expanding geographically. So we were originally a French investor. We're now pan-European and a transatlantic investor. And that's something that we have the luxury to have because we're backed by a larger company. We're an unpermitted cap investor, but we have also 7 other investment strategies within the group. We're a group of 250 person across 4 continents. So that's an enormous benefit for me and my team because we have the opportunity to invest in a much broader geographical spectrum, and therefore within those geographies have more choice and pick the best opportunities. So that's the first aspect, is expand geographically, look after the best opportunities, and ultimately we only have to do 10 to 12 deals per fund. So we'll find more quality assets if we look for a bigger pool. But a lot of people are doing that. You see a lot of European GPs that are now moving to North America and investing 20-30% of their funds. So a lot of people have the same strategy. So that's number one. Number two is we have a buy and build strategy that is responding to the issue that I was mentioning, i.e. creating optionality in your asset and have more opportunity to create value because you have bigger assets, more diversified, and by acquiring other assets at the lower price, you're reducing the overall acquisition multiple, so you're de-risking yourself. And by growing in size, you attract better managers as well, and you create more synergies. So at the end, there's a stronger likelihood that you will command bigger multiple, at least the same multiple than the one you enter. So it's also a very important strategy for us, and that works across all continents. We have offices, as I said, in 4 continents. We've done 64 deals, build-ups, over the last 5 years on our portfolio companies. On average, we do 7 build-ups per platform. So it's a very, very active strategy, and that has been paying off nicely.
But can I ask you, it all sounds good and well to diversify and continue, but do you ever worry that GPs such as yourselves just become sort of asset gatherers and it sort of begins to get slightly out of control?
Well, there's an issue of people trying to invest at all cost, and we're seeing more intense competition. So that means that we have to stay disciplined and clearly not overpay for asset. Now, every fund manager has to return capital to its investors. So the ability for people to hold on to their asset and just become pure asset gatherer, is not going to last very long as a strategy. That's a very defensive and kind of a runoff strategy. But what we're saying is that people are just trying to be, more agile. And to your point earlier, I think we will see more strategy bifurcating, more specialization. We see that in many industries. I think the private equity will go in that direction as well. You'll find more experts per vertical. And that's also something that we're thinking about is, as we grow, have people specialize in specific areas. That cuts across geography. But there's a real value, and probably expanding the range of investments, going from smaller cap to larger cap, but within the same sector. So that's a trend that we'll see.
Thanks. And if I can ask you lastly, what would you say, if you could only name one thing, was the thing that you were most concerned about going into 2019?
Well, the macroeconomic environment. I think we're all seeing the stock market dipping, the tensions between China and North America, the Brexit issue, the Italian issue in Europe. There's a lot of negative forces out there, and that is creating uncertainty. So that's one of the big concerns, is making sure that our portfolio is resilient and our management are prepared for potential dip.
Great. Marc Frappier, thank you very much.
You're very welcome. Thank you.